As recession fears rise, investors could turn their attention to companies who can hold on during a downturn with solid balance sheets and plenty of cash. There is no better example of an ironclad balance sheet these days and a mountain of cash than Apple, as the company heads into a very busy second half of the year. Is this a name that you want to own, or are there better stocks in that IT hardware space that offer perhaps more safety? Let's bring in Toni Sacconaghi, one of the top-ranked analysts on Wall Street when it comes to that hardware trade, managing director over at Bernstein. Toni, we've been talking to you about Apple for years now, and Apple has been, as I just described, that fortress balance sheet if there ever was one. So is Apple a stock that you would buy after it's shaved nearly a quarter of its value over the course of the last several weeks?
Well, good afternoon, Dominic, and thanks for having me on the show. Look, I think it depends really on your time horizon. Apple, from a trader's perspective, has a really unique seasonal pattern between June and September. So 14 out of the last 15 years, the stock has outperformed the market by an average of about 14 percentage points between this time frame. And it's typically because the current iPhone cycle is de-risked. And so there aren't a lot of expectations about what might be coming up in the quarter. And then there's a new iPhone that gets introduced in September. And so we've seen this pronounced seasonal pattern, and we may see it again. Expectations, I think, for this quarter are pretty reasonable. And again, Apple investors tend to look forward. So tactically, this historically has been a good time to own Apple. I'd say over the next couple of years, we're not as constructive. You're absolutely right. Apple has a fortress balance sheet, and it will, there's no risk to the company during a downturn, but it has a very transactional business model. More than 90% of its revenues are transactional. They really don't have a lot of subscriptions. And so if consumer wallets are pared back or directed, away from the home and spending more outside the home, Apple is vulnerable in an economic slowdown. It's the largest consumer company in the world. And I think that's the broader risk over the next, 12 to 24 months for Apple.
All right. So if that's the broader risk, then there have to be places in your coverage universe, Toni, that you feel are better risk-reward scenarios, given the fact that Apple may have a little bit more exposure to that transactional consumer trade. Is there some place in technology hardware, or are they all generally more transactional and based upon spending?
Well, I'd say within the traditional sort of hardware companies that I follow, IBM historically has been uniquely defensive. So IBM is often thought of as a hardware company. But the majority of its profit comes from software, and much of that software is a monthly subscription or a SaaS type model. All of its mainframe, 90% of its mainframe software is sold as a monthly license. Red Hat is a subscription model. So in IBM's case, we estimate that about 65% of the profits, software, maintenance, services, which are 2-3 year contracts, are recurring in nature, and that's much higher than your typical transactional hardware company. So in the great financial crisis, Apple actually outperformed by 20% during the downturn, in large part because its earnings held up better than other companies. So if you're strictly looking for safety and you have a pessimistic view on the market, IBM is likely the place to be. It pays a 5% dividend. It has this defensive business model. Now, the question, of course, is that already priced in? The stock is one of the few tech stocks that's actually, flat to up this year in terms of its valuation. And so the market may be anticipating some of that. But IBM is unique in the traditional hardware space from that perspective.